Hey guys, in this video I'm going to try and value everyone's favorite cable company, Comcast. So I'm going to use financial statement analysis and discounted cash flow valuation techniques to try and come up with a fair price for Comcast and see if it's a good deal right now. If you're new to the channel, my name is Dan. We do a lot of stock analysis on this channel. So if you're into that kind of thing, please hit that subscribe button so you can check out other videos like this. Okay, so here's Comcast business by segment. In the blue, we have the cable business. In the red, we have NBC Universal, which has many parts to it, which I'm going to cover in just a second here. And then you have Sky, accounting for 17% of the total revenues. Now, Sky is a European media company of which Comcast has a big stake in. So I like to see that they're branching out. They have a little money coming in from Europe. Gives you a little currency protection there. Now let's have a look at NBC Universal revenue, which remember, this in total is about 30% of Comcast revenue. So of that 30%, this is what we're talking about. You've got some broadcast television, cable networks. Those two together make up the majority of it. And you actually have quite a small slice coming from theme parks or films. So here I'm looking at the balance sheet of Comcast. Their liabilities to total assets ratio is 67%. That is okay. That is not extremely high. It is neither low nor high, basically. Their working capital is slightly negative. That number is in terms of millions of dollars. That's about $2 billion. And you can see that in their current ratio and their quick ratio because they don't have any inventory. Those ratios are going to be exactly the same. What this means is their current liabilities are more than their current assets by just a little bit. If the current ratio were equal to 1, that would mean current assets equal current liabilities. So they're just a little bit in the danger zone, I would say. And you can see that with their interest coverage ratio of about 4. So however much profit they make before interest and taxes, about a fourth of that goes towards paying the interest expense. So to be honest, I don't like to see that at all on the interest coverage ratio. Okay, so here's a DuPont analysis. I have a video on this in the description below if you don't know about this. But basically, we're looking at return on equity, one of the most important measures of a company's profitability from a shareholder perspective. And we're breaking return on equity down into its 3 components. And we're just going to have a look at about 5 years worth because, a company's profitability can really vary from year to year. You don't just want to look at 1 year. What we can see here is not a great return on equity. In the most recent trailing 12 months period, it's fallen to 12%. Let's hope that's not a trend. Let's hope that is only caused by some, temporary downturn, possibly due to the pandemic. Although for their business, I really don't see the pandemic would ruin their business, so that concerns me to see that decreasing. And when you look at why it's decreasing, the thing that sticks out to me is net income margin. Net income margin just measures for every dollar of sales you have, how much do you keep as profit? And in the most recent trailing 12 months period, the answer is about 10 cents. So that's not very impressive. The asset turnover is not very impressive. So in the most recent year, we're at 0.4. It's been as high as 0.5. But overall, it's pretty low. So for every dollar of assets we had in place, we generated about 40 cents in sales. That's a little capital intensive if you ask me. So any return on equity we really see them generating largely comes from this equity multiplier. In other words, it comes from their leverage, which is the weakest source. Now, Comcast does have a streak of increasing their dividends. You can see that in blue here. They also have a nice share buyback program. One interesting thing here I noticed is that they've bought a lot of their own shares back very recently in the trailing 12-month period. Usually when companies do that, it's because they feel their shares are undervalued. So that could be a good signal for us. Okay, so Comcast has a nice dividend streak, but it's really not a large portion of their profits. If you look at the blue here, there's their payout ratio, which is the dividend they pay divided by how much profit they had. They really keep quite a lot into the business for reinvestment purposes. Now in the green, we have the modified payout ratio. So that means we're looking at dividends plus the money they spent buying their shares back, all divided by total profits. Even that ratio rarely touches 50%, only jumping up to 92 in the most recent year, for what I can assume can only be because they found a really good deal on their own shares. Maybe they bought them all back when we had the big market crash in March. I don't know. I can only assume that's the case. But I would say the takeaway from this is that even though their dividend yield is less than 2%, you can expect that to grow over time. So how much is the company growing by? Well, if you look at their earnings per share over the past 5 years, it's pretty volatile. And if we just take a geometric 5-year earnings per share growth rate, we're going to get about 4.66%. When I try to estimate growth, I generally focus on earnings per share because it's a much less volatile measure than is free cash flows to equity. Okay guys, so although Comcast has only been able to grow their earnings per share at about 4.6% per year for the past 5 years, their expected growth rate going forward is a little bit higher. If we look at their retention ratio, which is basically the opposite of the payout ratio. So for every dollar of earnings, how much do you plow back into the business? 76.4 cents for this company. And you look at their return on equity of 12%, that implies, when you multiply the two together, they're expected to grow at 9.2%. That's quite a bit higher than what they have been growing at, and we're going to have to consider both what they've been growing at and this new expected rate and sort of form some sort of estimate of what they will grow at going forward. Okay, so now I would like to try and value the company. I'm going to use a discounted cash flow valuation technique called the free cash flow to equity model. If you don't know about that model, you can check it out in the description below. I made a video about it. But essentially, the model says the price of any stock should be equal to the sum of cash flows you're going to receive from being an owner of that stock. Now, to make the model work, we need a few assumptions here, or estimates. One thing we need is the growth rate in earnings over the next 5 years. And then you got to estimate a discount rate. Now, for Comcast, I've looked at their liquidity ratios and their balance sheet. That does concern me a little bit. They do have a higher default risk than some other companies. You can't deny that part of their business is declining, even as other parts are growing. So I'm going to be looking at a little bit higher of a discount rate than I might normally use. And let's see what they're worth. Alright everyone, so here I have a valuation matrix. Each cell is the fair value of a stock of Comcast, assuming a few assumptions. So what you can see here is on the vertical, you've got discount rates going from 6 to 9%. And on the horizontal, we have allowed the free cash flow to equity growth rate to vary anywhere from 5 to 8%. So basically, if I look at a cell like this one here, if I'm going to use an 8% discount rate and I assume free cash flows to equity can grow at 6%, the stock would be worth about $49 a share. Another way of looking at this is to say, okay, if I expect cash flows to grow at 6% and I want an 8% return, I have to pay no more than $49 for a share of Comcast. Now, which cell is the most likely? I actually think the one I highlighted represents the most likely outcome, but this is my personal opinion. Let's have a look at this valuation matrix below, where I essentially color it green if it's a good deal based on the current share price. So under the most optimistic assumptions, you're looking at a stock that is about 76% underpriced right now. Under the most pessimistic assumptions, 9% discount rate, very low growth rate, you're looking at a stock that is about 25.8% overvalued. When you look at the whole matrix, there's a variety of outcomes here. Overall, it does look like a good deal. There's more good scenarios than bad. Alright, so I have some insider trading data here for Comcast. You notice in the last 3 months, there's a heck of a lot more people buying shares than selling shares, 15 to 4. And the number of shares involved, you can see about 39,000 shares bought by insiders compared to close to 16,000 sold. This is a very good indicator, guys. Alright, so here are my final thoughts. Comcast has a below average balance sheet. Their business model is decent, not excellent. They do have economies of scale with their business, so the more people that watch their programming, it doesn't necessarily translate into higher costs for them. They have a lot of fixed costs. So these are positive aspects of their business. When we look at their growth rate and we factor those risks into the model, in the discounted cash flow model, we get a fairly mixed picture. There are a lot of great outcomes. This stock could be very undervalued right now. And there are some bad outcomes if the company doesn't do well. I would say it's an above average risk stock, but it is priced attractively. And when you factor in the company has bought tons of its own shares back this year, plus the insiders have been buying, you have a pretty clear buy here in my opinion. I really started off the video not liking the company at all, but by the time it was finished, I have to say it's probably not a bad idea to buy some Comcast stock. So those are my thoughts on it. Hit the like button if you like the video. Thank you for watching.